Today, we're going to talk about one of the largest real estate investment trusts over here in Canada, which is RioCan with the ticker REIUN. So I'll be doing a full stock analysis on this company to determine whether or not it is currently under or overvalued right now. As always, if you enjoyed this kind of content, make sure to hit the thumbs up and subscribe to the channel. Now, without further ado, let's get to it right now. RioCan is a real estate investment trust company created in 1981, and it is currently the second largest REIT of its kind over here in Canada, with a market cap of about $6 billion and an enterprise value estimated to about $13 billion as of June 30, 2023. On its side, RioCan has an impressive portfolio where they own about 193 properties all around the important markets in Canada, where most of these properties are actually some retail properties, but you also have a few residential units that have been purchased after 2018. In total, they are present in the 6 most important markets over here in Canada, and they also have some great retail quality tenants such as Loblaws, Canadian Tire, Winners, Dollarama, and Metro. And in terms of the earnings that they receive from those companies, you can see that about 20% of it come from the grocery and the pharmaceutical companies. After, you have about 14% that come from essential services such as financials and medicals. And after, you have about 12% that come from specialty retailers such as Sephora and PetSmart. So as you can see, their business model is quite simple, where they are simply buying a bunch of real estate properties around the country, and they are mainly focusing on buying great retail properties such as big supercenter. And so it makes sense that during the pandemic, we've seen that this company has lost a lot of value because a big portion of their tenants were actually closing their door during that period, and also all the different supercenters were all closed. And it also makes that at the end of 2020, they've cut off about 33% their total dividend income that they are giving to their shareholders every single month. Despite that, after the pandemic, we've seen that this company has regained some pretty good momentum, but this momentum has been rapidly stopped, notably by the hikes of the interest rate that obviously massively impact these kind of companies. So now let's examine what are the different metrics that will tell us if this company is currently under or overvalued right now. But first, you need to understand that to evaluate the value of a REIT, it is quite different than evaluating any kind of other stock. In fact, instead of using the classical financial metrics such as the payout ratio or the price to earnings ratio to evaluate the sustainability of these companies, well, we'll be using a bunch of different other metrics. For example, instead of taking a look at the earnings per share, in the case of real estate investment trusts, we'll be using what is considered as the FFO or the funds from the operations. In fact, those real estate investment trusts will use what is called as the depreciation to diminish the total value of their net income as for the value of their overall properties. And so it makes that they will extend the price of a real estate property, for example, over a certain period of time, and it also makes that this expense is not a cash expense. But at the same time, it means that the net income won't be a great metric to evaluate what is the real financial situation of the company. And so the FFO is a simple addition of the total net income of the company with its amortization and its depreciation, and where you'll deduct the capital gain of property sales. In the case of RioCan, over the second quarter of 2023, we can see that their FFO has been growing quite well compared to the same period but in 2022. After, you have the adjusted funds from the operations, aka the AFFO, which is considered as a better and more realistic metrics compared to the FFO. And so with this formula, you'll simply adjust the performance of the REITs over time with other different factors. For example, the addition of rent, the increase and the deduction of capital expenditures, and of routine maintenance amounts. As we'll see later on in the video, this metric is mainly used to determine what is the payout ratio of the company, so what is the sustainability of the dividend over the long term. But after, another important criteria to take in consideration when you want to evaluate the value of a REIT is the net asset value progression, aka the NAV. This is a simple formula when you take the total assets of a company that you subtract with the total liabilities and that you divide by the numbers of shares outstanding. Unfortunately, due to the increase of the capital expenditure, we can see that the Raocan NAV has been diminishing year over year. But talking about capital expenditures, we can understand that for these companies to be able to purchase other different properties around Canada, they must have a lot of capital to invest. And so it also means that they need to borrow a lot of money. This means that it is important as an investor to understand what is the structure of the debt from these companies to be able to understand how they'll be impacted by a future hike of the interest rate, for example. This means that we'll take a look at the maturity of these debts, but also we'll take a look at what is the current interest rate of them, because this will give us an overview of when those debts are gonna end. And by seeing what is gonna be the end of their current debt, this will give us an overview of what is the year where they need to renew their different payments of this debt. Just like you, if you had a mortgage, for example, on a 3 years with a fixed rate, it means that at the end of the 3 years, well, you obviously need to renew your payment to be able to pay all your mortgage. And it means that you'll have to make your payment at the current interest rate at that time. But the first metric to take in consideration when you analyze the debt of a REIT is the debt to EBITDA ratio. This will simply give you an overview of what is the portion of the debt compared to the final earnings. In the case of Raocan, for the second quarter of 2023, we can see that this ratio has been diminishing in a positive way compared to the same period last year, but it is still slightly over what is the ratio that is target between 8 to 9%. This is showing that at the moment, this company is using quite a lot of leverage to make all of these acquisitions, which also come with a lot of volatility and risk. But on their side, the company is justifying this high leverage because they have made a lot of new acquisitions over the last year. Now, in terms of the debt maturities and the interest rate, we can see that they currently have 3 main debt items. First, you have the debentures payable, which represents about 45% of the total debt, and you can see that it has a pretty long-term maturity ending with an average interest rate of about 3.37% at the moment. The second part of the debt is from the mortgage payments that represent about 37% of the total debt of this company, and this one also has a pretty long-term ending maturity with an average interest rate of about 3.31%. The rest of the total debt is coming from the lines of credit that have a pretty shorter maturity terms with a higher average interest rate of about 4.93%. After, another great and important metric to understand about REITs is their credit ratings. This is basically showing us a great indicator of the quality of the company according to other different firms, and it's also showing what is the possibility of the company to eventually borrow more money to make more acquisitions. And on their side, with a 3B ratings, it is showing that Raocan is undoubtedly an excellent quality company on that side. And finally, I've kept the best for the end, which is the dividends criteria. When you want to invest in real estate investment trusts, you need to understand that these companies must distribute about 90% of their total taxable income to their different shareholders, which will be distributed in the form of dividends. It means that on your side, you obviously want to benefit from these high dividend payments, and in the case of Raocan, despite having seen some quite important decrease in their dividend payments of about 30% at the end of 2020 because of the effects of the pandemic, well, they've been able to regrow their dividends every single year, where it's now sitting at about $0.09 per month per share owned. It means that every single year you can expect to receive some great 5.50% of dividend yield, which will be paid on a monthly basis. And an excellent news for Raocan compared to the other Canadian REITs is that it has a super low FFO payout ratio of less than 60% and a pretty good AFFO payout ratio of about 68%. This is showing that their dividend payments are pretty safe on the long term and that they are also very sustainable compared to other REITs such as SmartCentres with some AFFO payout ratio of about 95%. As you've been able to see in this video, Raocan is a quite important REIT over here in Canada with close to 200 properties in the country that are in the most important markets. Plus, at the moment and at these levels, this company can be very interesting for all the dividend income investors that are looking for great capital appreciation over time with some great potential dividend growth in their dividend payments. If you know me and if you know my portfolio, you know that this company is quite important in my portfolio, where it represents a certain amount of money that I receive every single month from it. But on your side, if you want to find other great Canadian REITs that are currently at discount right now, well, check out the video that's gonna be right over here, and I will see you soon. Peace!